Thank you for the invitation to speak at the 2025 Accountability in a Sustainable World Conference. I am Bridget Realmuto LaPerla, the CEO of Lion & Arc, a boutique sustainable finance consulting firm helping corporates and institutional investors view markets through the lens of sustainable finance themes and take action to compete. My professional experience in sustainable finance spans investment banking, impact investing, government, as well as buy and sell side sustainable finance research. Today, I'll present findings from a 2021 paper called Decarbonizing Everything. So I co-authored Decarbonizing Everything in the CFA's Financial Analyst Journal alongside fellow researchers Alex Chima-Fox, Dave Turkington, Stacy Wong, and visionary Harvard Business School professor and author George Serafin. The motivation behind the research was that investors are operating in an era of climate change and a decarbonizing global economy. There are new alternative data for investors to assess, but how? So the paper, we test 3 types of data in this paper, and our goal is to understand the circumstances in which they each add value to portfolio construction. To be clear, we do not want to opine on the best climate or carbon data for multiple use cases, but rather design a replicable model to draw actionable insights to improve portfolio construction. And some key findings, high level right off the bat, are that the metrics that vary widely across firms within an industry tend to matter more, and that playing to the strengths of various types of climate data can help investors design strategies to manage climate risks while increasing risk-adjusted returns. So let's dive into the data. To start, we've got 3 different types of data presented, and the bricks, that first row is how that data is created. The metal is what it's really good at. And then finally, that last row is what we want to raise awareness for and be cognizant of. So we use operational carbon intensity data from S&P TrueCost, which leverages company-reported carbon emissions from a company's operations, and it's scaled by a firm's revenue. So this is the Scope 1, Scope 2 direct and indirect emissions from operations that they own and then what they use to run those operations. Then we move to, understandably, this is very narrow in scope. Then we move to the total value chain carbon intensity data. And for this, this modeled Scope 3 data, which is upstream and downstream, so supply chain and the use of products and services, we add this model data to the operational carbon intensity data. For both of these measures, higher values are less desirable from a climate perspective. And then finally, we got the analyst ratings data. We use MSCI's ESG Intangible Value Assessment ratings, which is their IVA ratings, and it assesses a company's exposure to a given ESG measure and issue, and its management of that issue. The ratings incorporate both qualitative and quantitative information from multiple sources, and those sources have different units of measurement, so they use a framework to convert it and translate it and standardize it into a score between 0, which is less desirable, and 10, which is more desirable. And a note to note about these analyst assessments is that it helps us understand firms in industries like diversified financials and insurance that don't have carbon-intensive operations. We understand how they're positioning for a low-carbon economy. That's that qualitative piece to it. What we did to start was just basic long-short strategies for each metric. We designed value-weighted, in this case, market cap weighted, and equally weighted strategies between industries for each measure that we presented. So to do this, we sorted stocks within industries by each measure, going long half of the stocks for low risk within that industry on that measure, and short half of the stocks that were relatively high risk for an industry on that measure. We then designed cap weighted and equally weighted returns over the securities in each of the long of the low risk and short high risk sub-portfolios. The abnormal returns were calculated in excess of the Fama French 5-factor model plus momentum. And the big takeaways that I wanted to highlight from this slide is that there is a consistent negative spread between the long and short portfolios, which on the portfolio outcomes, which indicates that some metrics achieved more than others on carbon reduction, but all of them had carbon reduction. And then additionally, while we did see alphas, and they are positive, Most are not significant at this point. So although it's not shown, we also tested patterns in standard deviation and annualized returns in the industry level and found that the average returns are consistently positive across all 6 strategies. This suggests that on average, across industries, firms that are better positioned to compete in a low carbon economy had better returns. And finally, important to note that the operational carbon intensity and the total value carbon intensity factors have around a 78% overlap in holdings, but only about a 50% overlap with the analyst rating strategy. This indicates that the data are capturing different aspects of climate risks. And so we dive into that with the next slide. So we use a simple and effective measure to test which data is better at predicting returns for a given industry. This coefficient of variation is simply the ratio of the sample standard deviation over the sample mean for a given industry in a given year. We focus our attention on the incremental information offered by Scope 3 data or analyst ratings, above and beyond the information contained in that operational carbon emissions data. What we found is that Scope 3 data and analyst ratings offer most value precisely in the cases when that operational emissions are less relevant. And we use this measure, in using this measure, we found that the dispersion in firm-level emissions is significantly higher in industries where climate is deemed material than in those where it's not material, whereas there is less dispersion in the analyst rating for high carbon-intense industries. And that's potentially a herding effect resulting from uniformly low ratings across high-intense industries. But by studying basically these measures and this dispersion and comparing the correlations within industry to the different metrics and understanding these relationships, it allowed us to create these 3 rules to design this model. So with this rules-based approach, the weights of each industry in the portfolio are dynamically weighted. So on each portfolio formation date, we calculated portfolio weights based on the coefficient of variation from the previous trading day. By using the coefficient of variation to the chosen metric, we then weight it across industries for a broad market strategy. So the model is the highest performing and chooses a metric of operational or total value chain carbon intensity for about half of the industries and uses analyst ratings for the others. And you can see through this rules-based approach, that top black line, the portfolio alpha increases to 4.1%, and we observe these dynamically formed and weighted portfolios can effectively lower carbon exposure. This is suggested by the large negative spread in portfolio outcomes, which we highlight in those red boxes. Alternative data continues to evolve. And so one of the points of this paper was to be really practical and to allow investors to navigate different types of new alternative data on climate risks or whatever measure it is they're trying to grapple with. One of the many ways we can build out this model is to use carbon markets pricing data to understand the costs and revenues from a company's direct and indirect emissions. So that's that operational carbon intensity that we were initially talking about. And so here what we're walking through is Spark Change's carbon alpha data, which forecasts the effect of carbon pricing on the costs and revenues of global companies. And so what this allows us to do is, again, understand the pricing piece now that we know, those outcomes. And what I point out on the right is that basically these compliance carbon markets are on the precipice of a paradigm shift, and many industries are going to lose free allowances, which will ultimately impact their margins in the coming years. And for example, not presented, but when we think of utilities, energy, and industrials, particularly in Europe, are most exposed to carbon pricing today, the materials sector is set to see the strongest increase in carbon costs by 2030. And so things to think about as you continue to refine this model. So finally, to wrap up, Decarbonizing Everything is a paper with really practical insights that are still relevant to investors today. Some major takeaways from this paper, as noted initially, is that metrics that vary widely across firms within an industry tend to matter more. Playing to the strengths of various types of climate data can help investors design strategies to manage climate risks while increasing risk-adjusted return. And alternative data continues to evolve, and investors that are positioned to systematically test these new data can glean insights to then leverage the merit and applicability of those data in their portfolio construction and work to reach their goals. So thank you again for having me, and look forward to speaking to all of you.